In this video, traders, we're going to look at what is discretionary trading and the advantages and disadvantages of discretionary trading and being a discretionary trader. Stay tuned. Hey traders, a very warm welcome to you. If you're a subscriber, welcome back to the channel. Thank you for your support. If you're new here and if you've stumbled across this video, a warm welcome to you too. And hopefully you'll consider subscribing after the video for more videos from me and other traders on this channel. Okay, let's get right down to it. What is discretionary trading? So generally, we have two aspects of trading: discretionary trading and automated trading, or algorithmic trading, however you want to put it. The difference is basically a human making the trading decisions and placing the trades, or a computer, a system, a strategy making the trading decisions and placing the trades. Sometimes we can have a hybrid of the two. We'll talk about those in a second, but those are generally speaking the two broad terms. Let's look at what is a discretionary trader and what it's all about, pros and cons of it. So discretionary traders, most of us probably watching here, we look at a chart, we look at a market, we make our trading decisions, we see a setup, we pull the trigger, we open the order, we open the broker account, we open the order ticket, we put the order in, we pull the trigger, we put our stops, we put our limits in. That's generally what most of us are doing who are watching this, and what I would do most of the time. The advantages of that are that you can adapt to changing conditions. So you can come into the day, assume you're a day trader, you've got a trend in the morning, you have a range bound lunchtime session, you have a trend in the afternoon. You can adapt and use different strategies for the changing conditions. Very often, systems are slow to adapt. Sure, you can program systems in to change the current market conditions and be quick, but as a discretionary trader, as a human being, generally, it's easy for us to eyeball something and say that's a trend, then come up with some kind of way of telling computer that's a trend. We can use an ADX, we can use a distance from moving average, all the kind of stuff we can do, but really all we're trying to do is trying to quantify what we can already see as humans. So let's say we are trending in the morning. We take a trending type trade. We use a trending strategy for that. We don't use a trending strategy at lunchtime. We use a trending strategy in the afternoon. For an example, that would be likely a profitable day for us, or a good chance of being profitable. A computer, someone who's non-discretionary and automated, might well be using a strategy that it thinks is right from the prior day or the prior month or the prior year, prior 10 years, and have a losing day on it. So there is that advantage. And also, as conditions change over the week, over the month, you have systems that can be reasonably clever, but ultimately they're executing maybe one, two, maybe a handful of trading strategies based on the logic you've given them. So you have to feed them more data. So I think as humans, we're better at just looking and saying, hey, that's this type of condition, that's that type of condition. I want to hold off from this. I want to do this or do that. Look at the disadvantages in a second, which are quite big. But the other advantage is that you harness the power of gut feel, something you can't quantify. And I've actually done a video about this before: intuition and gut feel. As traders, we just tend to learn and improve, and the more time we put in front of the screen, the more we're filling our minds with different scenarios, different conditions. And very often we come up to a case where we go, I just don't like the feel of this now. It's just not quite the time to pull the trigger. I might have this, I might have that. This is different from hesitating to pull the trigger. There's a slight difference here. If you give yourself a little bit of intuition, allow yourself a little bit of intuition with the trigger moment, you might say, I want to wait a little bit. It doesn't feel like it's flush enough yet. And sure enough, you get a second flush, or you get a real brutal flush, or a real heavy move. And whatever it is that's made you pick that out, you've just picked it out. So if you're purely a non-discretionary, purely automated, you lose that. And it's something that I think you can definitely harness as a trader, although it's very difficult to quantify and very difficult to train. The other thing is you can be flexible. So you get something extreme happening, the flash crash. If you've got an automated strategy, yes, I'm sure you can put parameters in that say, hey, if the market moves more than this, don't get involved in it. But actually, the algos were the ones panicking and trying to get out, and they were actually exiting based on the criteria, but ultimately they're the ones causing this problem, or adding to the problem, should I say. Whereas a human, you can say, hey, you know what? This is kind of, way out of my realm of profitability. I'm going to stand and watch this. Or let's say data's come out, it's moved something aggressively. you might add the parameter in that, hey, there's a rumor coming out from here, there's this and that and the other. And yes, of course, complicated algos can take in as much information as we can, but I think as human beings, we can decipher emotion better than algorithms can. Emotion, what's the emotion? This feels very emotional move. We have a lot of emotion coming from the news flow. There's a lot of emotion coming through from this catalyst. The market's moving much more aggressively. You get that feel from it. It's actually other people from behind it, even though a lot of the trade is all algorithmic and is driven by computers anyway. But the point is you kind of know what their objective is. They're trying to make money short term, they're trying to make money long term, they're trying to do this, trying to do that. So you get a bit more feel for the market flow. And obviously, these things, guys, we can't always quantify it. We can't always say this, but that's like a lot of things in life. Some things just happen and it's the way it is. All right, so disadvantages are, this is the biggest one. This is the biggest one. And what a lot of our videos we do on the channel are getting over this emotional attachment you have to the trade. That is the biggest thing. Your emotional attachment to the money, emotional attachment to the entry, the exit, while it's moving. A lot of the psychology things we do in trading and learning and improving and studying the great traders is becoming a better trader with not necessarily less emotional attachment, but not letting the emotions dictate how we trade. And of course, if you're purely automated, purely doing everything from an algorithm perspective, there is no emotion there. But if we can control it and harness it, it can be way more powerful, in my opinion, than just purely automated. Obviously, disadvantage is that you have to have flawless execution and confidence. You've got to, if you've got a strategy, at least a strategy for an automated trading strategy, it's going to be executed like clockwork. There's going to be no reason why it won't pull the trigger if the logic's correct with the code. Whereas we may well not pull the trigger, we might do this, we might do that, not necessarily from a perspective of gut feel stopping us, but purely because we weren't there at the screen, our focus was elsewhere, we didn't quite get it right. They're just human beings, this is what it is. And confidence as well, the confidence in the strategy to pull the trigger. Again, it's very similar to the emotional attachment, but you have the confidence, to keep pulling the trigger and executing the strategy. And then of course, human error. Computers don't really make errors as such, they just do what they're told with the logic. The logic might have errors, the code might have errors, but we make errors all the time. We have too big a position size, we go long, too early, too late. It could just be an operations thing, like, putting the wrong ticket in. It could be purely having a bad day in terms of how we're reviewing the market. There's all sorts of things there. So that's discretionary trading, is making decisions based on your own feel, intuition, strategy. In my opinion, I think that's the most powerful way if you can overcome the biggest thing, which is the emotional attachment, and you can adapt and you can kind of do this. There's nothing wrong with having a hybrid kind of strategy where maybe you have some kind of automation that presents ideas to you, that does initial filtering, so you haven't got to do the kind of dog work, so to speak, and go through trends and go through this if you're that kind of trader, and presenting ideas to you, or using computer to highlight levels that are of interest. But ultimately, I think the best traders are often discretionary traders. Not to say you can't go down the route of non-discretionary algorithms, perfectly possible, and a lot of people are making money from that, but it's just personal choice and how you sit and how you think that you can make this work for you as a trader. All right, guys, see you in the next one. Take care. Keep the risk managed, whichever side of the coin you're on. Take care. Bye-bye.